We are here today with one of our preferred lenders, Patrick Langhans. Patrick, thanks for being here today.
Thank you.
Yeah, and we are going to ask him just different questions and let him explain a little bit about the nuances of a resort market.
I'm Stephanie Ernst, and this is Lisa Gibson, and we're realtors here from Breckenridge all the way through the Vail Valley. We shoot videos weekly focusing on real estate and lifestyle, so be sure to hit that subscribe button below so you don't miss any future videos. So Patrick, why is it important? Why do we as realtors hammer home to our clients that they should use a local lender?
Yeah, that's a really good question. So using a lender that understands the market where you're buying, it's very important. Most clients who actually go through the process of lending, 65% say they have a bad experience. And a lot of that's just because you're in a unique market, it's a small market, and a lot of lenders don't know how to actually get the deal done.
We want to get to the closing table.
That's very important. That's very important. You also have your earnest money that you put down first. It's like an initial down payment. And there are points in the contract. There's about 45 dates in the contract that need to be met. And if you're using an out-of-state lender that doesn't understand the Colorado contract and they miss one of those dates, then your earnest money could be at risk. You could actually lose it. You'd be in default of contract.
And with the numbers and the size of our average contracts here, that's not a few bucks. So we definitely want to protect that earnest money.
Tens of thousands of dollars.
Well, I know personally, I've had a couple deals that have gotten very touchy at the end, and one in particular that we were past all of our loan deadlines. 5 days before closing, this person's lender, out-of-state lender, realized they could not lend on this property. And my clients are fortunate enough, they were able to pull $4.2 million out of their business until they could finance the home 6 to 12 months later. But not everyone has that. And it was incredibly stressful, with a lot of money on the line.
Right. And that does happen. So it is hugely important to choose a good lender. Yeah. And Patrick, tell us again, if you could just go over the, some of the nuances and the challenges of a resort market. We do have a lot of condos. I think that plays into the challenges as well.
Yeah, the biggest challenge right now is condos. When you buy a condo, it's kind of like having two people that need to get approved. You need to get you, the buyer, approved, but then we also need to approve the actual condo community. And there are 30, 40, 50 different rules that need to be met to qualify for a standard mortgage. So actually a lot of the condo projects up here, they don't qualify for a standard mortgage. So we have to do what's called portfolio lending. So the bank that you work with on a condo in a resort area has to be able to lend their own money and step outside normal government regulations, Fannie Mae, Freddie Mac. They have to kind of be able to make their own rules. So most of the local lenders that work in this area can offer what we call portfolio lending. So they don't have to follow Fannie Mae, Freddie Mac, jumbo rules.
And you're also working with underwriters who understand this.
Yep.
And everybody up here is used to this, right?
Yeah.
They're making their bread and butter. They're doing these deals every day on these kind of transactions versus an out-of-town lender. And again, nothing against your lender from back home, but they will probably tell you they can get the job done, thinking that they can, and then not realizing how intense some of these situations can get with qualifying the HOA itself.
Yeah, so there's not a database of condo projects that actually meet normal guidelines. So it's every time someone buys a home, we have to get that condo project reapproved. So it's transaction by transaction, and you have to be very familiar with what it's gonna take to get done. And the biggest holdup on them is short-term rentals. Usually people buying second homes in this area will want to do some sort of short-term rental to supplement the payment, but Fannie Mae, Freddie Mac, and most lenders don't like that. So that's why we have to do the portfolio loan.
Wow, so many details. And I know, having grown up in Texas, not as many condos in the suburbs of Texas, a lot more of your big ranch style homes. And those lenders just don't have these products. You know, so thank you for explaining some of that. And another thing that we're always trying to coach and guide our clients on is getting a pre-approval. So if you could very quickly just explain what a pre-approval is versus a pre-qualification. And then why is that important? Because it's kind of a pain. I mean, let's be honest, all of this is kind of a pain. So why do I want to do it before if I don't even have a home I've picked out yet?
So lots of people look at the pre-qualification or pre-approval process as a bad thing. And the biggest pushback I get is, you're gonna pull my credit and you're gonna hurt my score. The truth of the matter is, me pulling your credit once isn't gonna hurt your score. Now, if I pull it and then you go apply for 5 credit cards and go try and buy a Ferrari, that's that's gonna bring your score down because it looks like you're running out of money. But me checking your credit once isn't gonna hurt it. The difference between a pre-qualification and a pre-approval, there's actually no defined legal definition, but the accepted definition would be a pre-qualification means I've looked at your credit, your income, and your assets on your application, and it looks like you're gonna qualify, but I don't have any documentation to back that up yet. So basically, you filled out an application, but I don't have any documentation. A pre-approval is all documents verified. I verified your income, your assets, your credit, and unless something changes with those things, we're pretty much 100% sure that you're gonna qualify.
Well, and as for a realtor, the flip side to that, or, you know, in addition to all of that, we want to know where these folks are at. We don't want to be showing them properties that they simply can't afford. Or, you know, sometimes too, people are shopping in a lower price range. They don't even realize they could afford even more and get into a nicer place that they wanted. So for their benefit as well, they will want to know where they're at and what kind of homes they can be looking at before they just head out and start spending a whole day searching around for different homes, right?
And the best thing about getting pre-approved is we can show you very specific numbers, estimated payments, estimated cash out of pocket, different loan programs that you qualify for. And the best part of that is it's all free. So one of my favorite things about real estate is gathering information is free. You don't even write a check until you're under contract. So I rather go be looking at homes already knowing what type of loan I'm doing, what type of payment, how much money I need, and what loan program I'm doing.
That's great. And then as a realtor, when my folks do find a home that they fall in love with, I want us to get that house. So if someone is not pre-approved and they fall in love with 123 Main Street
on a weekend.
Now,
Sunday,
Patrick, you do work a lot of weekends. But Sunday, 6 p.m. on a holiday, Easter Sunday. They fall in love with this home, and you can pretty quickly turn around that pre-qualification, right? Like, okay, give me the numbers, give me the things. But the pre-approval is a little stronger when you're presenting that to the listing agent, right? Because then I know you've actually verified the income. You've actually checked the credit score. You've spent time digging through this, and that's a couple-day process generally, is it not? Or what are you,
If it's done right, it's a couple days. But it gives you a competitive advantage. Most of the time, when you submit an offer, if I'm your lender, I'm talking to that listing agent.
Correct.
And I'm saying, these guys are rock solid. They're as good as cash. We verified income, we verified assets, we verified credit. It gives you some negotiation power.
Correct. And so one of the things when we present an offer here, we're going to present that offer as a little package. We're going to have the contract. We're going to have proof of funds that you as the buyer have the money for what you need to bring to the table. And then we're going to have this pre-approval letter. And I'm going to submit this little package. And then I'm going to say, by the way, pick up the phone and call Patrick. And the first question that listing agent is going to say is, do you work in this market? What are your products? Can you actually close? on this short-term rental in a condo with all these other variables. So we want to be able to put the big bow on the package when we present it as realtors representing you and doing everything we can to get you this contract.
So you're the bow on the package, I think.
I guess so. If you look at it from the seller's perspective, they're looking at your offer and saying, do I want to take my property off the market and stop accepting more offers to go with this one? The top 3 reasons deals don't go through are inspection, appraisal, and the lender screwed up. So getting that pre-approval done up front, make sure you can at least eliminate one of those.
Right. Absolutely. So when people first start shopping here, a question we always get is about the rates. They like to ask us, which we can talk about that a little bit. We can say, yes, they're trending up. Yes, they went down a little bit today, but that is not necessarily our specialty. Our specialty is finding you the most amazing property. So that's when we refer someone like Patrick, and you can talk very specifically about interest rates and some of your programs. I just feel like there's so many options out there right now for lending, and depending on who you are and all the different, criteria that you're looking for, right? I just feel like there's a lot of different programs. So tell us about some of those.
Yeah, so rates work a lot like car insurance or home insurance. When your rate's calculated, we're looking at your basically driving record, which would be your credit report. So riskier you are on paper with car insurance, home insurance, that kind of stuff, the higher your rate. Mortgages work the same way. So like with car insurance, you have an accident, a speeding ticket, and you ran into a building, your insurance is going to be a little higher than someone who has perfect driving record, right?
Yeah.
So with mortgage rates, it's all about risk. So we look at the total risk of your profile, the property, how much down payment, credit score, are you going to live in the property, are you going to rent it, is it a second home? All of those factors go into determining your rate. So it's a hard question to answer. It's really different for every person. They also change every single day.
Right.
So it's like Apple stock changes every day.
Wow. Okay.
So do mortgage rates.
Okay.
Now, some of the programs that can determine your rate, there's a million programs too, and each one has a different rate. Wow. So what we're seeing a lot, most people who buy in this area are doing second home or investment property, which will have a slightly higher rate than a property you're gonna live in. So when you're looking online at rates, what you usually see is an owner-occupied rate with perfect credit. So you see a perfect scenario.
Okay.
So again, back to talking to a lender early in the process, it's important to talk to them early so that we can run that scenario for you and help you determine what your rate will be.
That's a pretty involved process.
It is. We look at everything.
Wow.
Hair sample. It's not that bad.
Yeah. It feels like it though when you're collecting all the documents. My gosh. Yeah. Okay, so maybe you could just give an example or two of some of the products you have. We deal a lot with jumbo loans. We have a lot of folks who own their own business. How do you work with all that on top of our unique properties? What do you, I guess kind of in that same camp of why a local lender?
Yep. Right. So a lot of people right now are doing more unique loan programs. Your standard that most people think of is a 30-year fixed. But right now we're seeing a lot of people do adjustable rate mortgages. And the reason you would do an adjustable rate mortgage is you actually get a lower rate than a 30-year fixed. And the forecast, at least right now, is that rates are going to continue to fall. So on an adjustable, it actually benefit you if rates are dropping because your rate's going to be going down.
So you don't really lock in.
You're locked for a short amount, like 3, 5, 7 years. And then after that period, it would start adjusting.
Which is actually great considering that most people don't own for more than 3 or 5 years up here, right?
Yeah.
You buy the property, you think you love it, and you might, but then life changes and the kids grow up and just things happen. So we definitely see some shorter time periods where properties up here in the resort markets are being owned.
Yeah.
So that could be an amazing program.
Yeah. So if you get a discount on the rate and you're only going to be in the home 3 years, do an adjustable. We're also seeing a lot of interest only right now. So the nice thing about an interest only is your payment is a lot lower than a fully amortized 30-year fixed or even an adjustable rate, because all you are required to pay is the interest that's due every month. And that helps people with cash flow. So people who are short-term renting or renting out their properties, it helps make cash flow easier. The other nice thing with interest only, the payment adjusts every month, not necessarily the rate, but the payment. So let's say you're cash flowing that property, you're renting it out, and you're bringing home extra money, you can apply that to your mortgage balance each month, and your payment actually gets recalculated based on the new balance. So we're seeing lots of interest only too.
What about, I know back in the day, we were seeing a lot of 3-2-1 buy downs. Is that a thing right now? What is that?
So huge thing, a 3-2-1 buy down is a temporary rate discount for the first 3 years of the mortgage. So you literally get a 3% lower rate the first year, 2% the second, 1% the third. If you even have the loan that long, you can, refinance into a new loan if the rates are lower. But the great thing about it is it gives you a huge discount right now while rates are a little elevated over historically. And let's say you do refinance. So all that discount, that 3 year of payment discount, goes into a bank account that's held by the lender. And each month they're crediting your mortgage bill for your savings. If you do sell or refinance before those 3 years are up, you're gonna have a little money left over, you get that back.
So you don't lose that money.
It's impossible to waste it. Yep, and the seller pays it.
And given the interest rates, I think that's a really big deal right now.
Yeah.
And then oftentimes, I don't know, this is a question. I know sometimes we ask the seller to kick in and help buy that rate down. Is that always how that works, or is that just something that a seller can offer?
So on a 3-2-1, it's a temporary. You can also do a 2-1 or a 1-1. A temporary buy down, it's always the seller. Okay.
Yeah.
But there's other types of buy downs. There's a permanent buy down where you pay extra money to get a below market rate. You can have the seller pay that.
Okay.
Or you could pay it if it makes sense.
Interesting. I'm going to switch gears here really quick and talk about, because we deal with these a lot, Steph, which is investment properties, or we have many of our clients, I'd say 90% or more of the folks that buy up here want to rent out their properties while they're not using them.
Yep.
So is that something, do you look at that rental income when you're helping calculate the mortgage, or look at their income? Does that count towards their income?
Yeah, so that does count depending on the lender. So this is another reason you got to be careful. Short-term rent is going to get you more income than if you were to lease out your property for 6 months or a year. So if you're trying to qualify with that income, it's important that the lender will use short-term rental income to qualify you, but a lot won't. So since we're familiar with the market, we will. But yes, to answer your question, if you're going to rent out your property, we can project what the rental income will be, and then we can use that to help you qualify.
That's amazing.
Yeah, it's actually easier to qualify for an investment property technically than it is to buy a home you're going to live in.
Because you have the rental.
Because you have the rental income.
And I love what you're saying about your company and local lenders know how to kind of work that system and are set up to allow the short-term rental income to assist with that qualification.
Yep.
So that's huge.
Yeah.
Well, I know I have a handful of clients that are business owners and they're wildly successful, but their tax returns don't necessarily represent the income that comes through the door. So do you have a program or any way to work with those buyers, Patrick? What's that look like?
Yeah, so self-employed people struggle a lot qualifying for standard loans. Your CPA's job is the opposite of mine. Your CPA wants your income to be as low as possible. I want it to be as high as possible so I can help you qualify. So we're butting heads, me and your CPA. Good news is we do have some of those portfolio programs. Again, portfolio programs, a special loan that we lend on. It doesn't have to follow Fannie Mae, Freddie Mac, jumbo guidelines, which most banks do have to follow. So we have 5 or 6 programs that help self-employed people qualify because we won't even look at your tax returns.
That's awesome.
Wow. You don't even look at the tax returns?
Yeah, so that sounds scary. People are always like, oh, are we repeating 2008?
If you're showing
Your bank statements,
or $40,000 a month coming in,
Yes.
right? So you're looking at that versus the fact that they wrote everything off last year.
Yeah, so we'll look at 12 months of your business bank statements, total up your deposits, average it, that's your income. We have one where if you're 1099, if you get a 1099 every year, we'll use 90% of your 1099. We have one where if you just have a lot of money, so really good for retired individuals. I had a client that had millions of dollars in the bank. They were retired. They were good for the loan. They were going to make their payment, but they didn't have any income to document. So they're kind of make sense loans is what I call them. We look at the whole picture to determine whether you're going to make your payment instead of sticking to the 100-point checklist that Fannie Mae and Freddie Mac require.
Well, I don't know. I've had some clients I've worked with in the past that when I hear the products you've had for them, I want to ask them who their CPA is and hire them.
Yeah.
Because,
Yeah.
because they have worked some magic.
Yeah.
So,
Yep.
wow, that is fascinating. And that is great to know because I know we do have a lot of business owners that end up buying homes out here.
So if someone told you no, like another lender, or you just don't think you qualify, it's at least worth a conversation.
So working with someone like Patrick is a very good idea because of the customization that can go into everything that you do in every aspect of working on someone's loan versus working with the big banks. Now, trust us, we do not get paid by the lenders. We really just want to recommend people that are going to help get you to the closing table. So again, working with some of the bigger banks, you're calling an 800 number. You may or may not get the same person on the phone, and it's just a much different process versus working with someone local like yourself.
And you're not going to have the weekend access. Your time is valuable too.
You spend your time and your weekends,
but
Yeah.
sometimes it happens.
Yeah, if it's critical, you guys are answering the phone.
Yeah,
right?
I mean, the truth of the matter is most people are looking at property after hours or on the weekend. So we have on call. We're just a small group of people helping people buy homes. So
Right.
the person that approves the loan, the underwriter, I have them on speed dial. The person that closes the loan and actually sends the wire to the title company, I have them on speed dial. So you're not just a number, you're a client.
Yeah.
And big banks are great, right? They do really good with checking accounts, really good with savings accounts, business loans, but all I do is mortgage. That's it.
That's amazing.
Yeah.
And so, again, no offense, but some of the folks out there are they're working certain hours, they're working for a certain hourly rate. And I don't know, I've worked with your company and a couple other, again, local companies where you guys don't sleep until you get the job done. Or you're just like, we swear to you, we're going to help bring you guys to the closing table. And you guys don't rest until you make it happen. You will do everything within your power to help all of us close a deal versus someone who's just like, sorry, I'm off today.
Yeah. Well, we're 100% referral. We're maybe helping 15 to 20 families a month.
Wow.
A big bank is probably helping tens of thousands. So if they screw up the loan, they're going to be okay.
Yeah.
If I screw up a loan and Lisa never calls me again because I made your client upset, that's going to impact me.
That's right. Yeah.
So
there's just a different level of service there, right?
Commitment, really.
Yeah, and commitment. I like that. Yeah.
And I've actually been in this situation before too, and I've seen this with you and your team, that yes, well, you want the business and you want the loan, you've actually referred them somewhere else if you've not had the best product.
Yep.
And I think that speaks volumes to your character and the service you provide when you can say, you know what, yes, I can get you to the closing table, but there's really this other option, and I just don't have it.
Yep.
That you should dig into.
Yeah,
So personally, thank you for that.
No worries.
That's rare.
It is
Yeah.
rare because you can get 98% of them there, and we have some challenging properties.
Yeah.
But I think it just speaks about who you are, who we're working with, and
Who we're referring.
Yeah.
Yeah.
We want to be a reflection of you. So
Exactly. Well, there is a lot that goes into this. I like how you just call it resort lending because it truly is. There are so many different nuances. So when we suggest someone, we're doing it for a major reason, and it's very important. And I want to thank you for your time, and thank you for all of this. It's been super helpful. I hope all of our people out there watching have found some value in this.
yeah, thanks for having me.
Patrick, truly, thank you again for your time. We really appreciate it. And
Thank you.
if you guys have any questions for Patrick, his number's here on the screen. Be sure to pick up the phone, give him a call, but also don't hesitate to call Lisa and I, and to subscribe to the channel so you don't miss anything moving forward. We're excited to help you buy your dream mountain home.